The chart is the last place the truth shows up. Stop waiting for spot. Premiums move first, charts move last. Physical tightness pushes the premium up while paper trading keeps the screen polite. In 2025, the New York-London tug-of-war can flip fast, and small buyers learn it at the counter. We are going to follow the paper price, the metal pipeline, and the moment they decouple. If you blink, you overpay. On March 18, 2020, silver hit an intraday low of $11.64. In human terms, that print was a headline, not a checkout price. The same day, the real market was the sound of a quote getting pulled, then replaced with a higher one, then replaced with no stock. If you only watch the candle, you missed the first ambush. The COMEX silver futures contract is 5,000 troy ounces, which means you pay first. The number on your screen is the price of paper obligations, not a promise that a small stack of rounds will appear on your desk. That 5,000-ounce unit tells you who the arena is built for. Big lots, big plumbing, big players. Retail lives downstream, where the faucet sputters long before the reservoir looks low. COMEX delivery is structured as 5 bars of 1,000 troy ounces. It looks like a simple physical contract, but it is a warehouse-native format that your local shop cannot slice for you on demand. This is why your premium can explode while the futures market still looks liquid. The pipeline is made of heavy bricks, and you are asking for teaspoons. When the scoop runs out, the screen can stay calm for a while. LBMA good delivery silver bars are specified around 1,000 troy ounces, and bars made before the 1st of January 2025 can still sit in a wider 750 to 1,100 range. A dealer refreshes a cart, then the shipping estimate jumps. Then the payment method gets restricted, and suddenly the only thing that feels available is a bigger bar than you can comfortably move. The mini scene is always the same. Spreads widen, lead times stretch, allocation gets whispered, and you are left holding a receipt instead of metal. COMEX deliverable silver must assay to a minimum of 999 fineness. Here is the translation. The system is engineered to settle cleanly at the wholesale purity and wholesale form, even when the retail shelf is barren. Purity is not your problem at that moment. Availability is. When supply stress hits, everyone fights over the same standardized units first. That fight happens behind the curtain, and you only see the aftermath as a premium. The main COMEX silver contract lists active delivery in March, May, July, September, and December. That is where the trap closes. The squeeze risk is tied to a calendar, not to your favorite chart pattern. If you are a small buyer waiting for a perfect dip, the clock is not on your side. The wholesale world stacks obligations into those delivery windows, and the retail world feels the tremors as soon as the pipeline tightens ahead of them. A smaller CME silver futures contract was launched with a 1,000-ounce size and began trading on June 15, 2013. You think micro means retail, yet it still speaks the language of warehouse units and professional settlement. It lowers the doorway for traders, not the bar size for buyers. So the screen gets more ways to trade paper while the physical bottleneck stays physical. That mismatch is not an accident. It is the business model. The same micro contract was marketed with minimum initial margin of $2,475 versus $12,375 for the full-size contract. A margin screen lights up, someone takes a position with less cash, and the paper side gets even louder. Then the mini scene hits the physical side. Dealers tighten buyback spreads. Shipping insurance rules change, and you are told delivery is not the point anyway. This is how paper volume can surge while physical premiums rise in a different universe. On August 6, 2020, the Silver Institute highlighted silver-backed exchange-traded products at about 1.25 billion ounces. In practical terms, a lot of demand can arrive as a button press, not as a truck at a mint. That matters because paper demand can inflate exposure fast, but it does not mint you an extra round. When the crowd rushes in through the paper door, the physical hallway gets clogged and premiums move first. Through February 21, 2019, the U.S. Mint recorded about 6.08 million Silver Eagle bullion coins sold for that year to date. So you get charged up front. The pipeline can be drained by wholesale demand before most retail buyers even notice the mood has changed. When the mint and its suppliers get stretched, the distribution becomes rationed, and the storefront experience turns into scarcity theater. The beep at the counter becomes your only honest indicator. On February 21, 2019, CoinWorld reported silver closing at $15.91, while single bullion coins retailed close to $19. It looks like a modest difference, but it is the market yelling that the screen is late. That gap is not a typo. It is the cost of immediacy when supply is tight. People who waited for spot confirmation paid more, not less. The premium moved first, exactly as it always does. On October 13, 2020, AUS on February 9, 2021. The U.S. Mint set a production limit of 327,440 for a 2021 American Eagle 1-ounce silver proof release. In human terms, the limit is the wall, and demand is the crowd pushing against it. The wall does not move just because spot dips 2%. When supply is capped, the premium becomes the pressure valve. Ignore that, and you will keep mistaking a calmer chart for a safer entry. On October 10, 2025, Reuters quoted a market briefing describing about 500 million ounces sitting in COMEX while London faced tightness. Which means you pay first. Giant stockpile numbers can coexist with local scarcity because location, form, and deliverability are the real constraints. Metal can be in the wrong place, in the wrong unit, under the wrong claims, at the wrong time. Your chart does not show that friction, your premium does. At the end of April 2025, Reuters reported 22,859 tons of silver held in London vaults. It looks like plenty, but it is a moving inventory inside a professional network, not a guarantee that your dealer has tubes on the shelf today. When metal starts flowing across hubs, premiums react to the tension before spot prints the story. The big loop is this: who gets filled first when paper and physical disagree? You saw the gap. The screen whispers while the counter screams. Now we build the machine that makes premiums jump before spot blinks. COMEX rules require delivery as 5 1,000 troy-ounce bars, with 10% weight tolerance. Here is the translation. Delivery is built for pallets, not for your tube. When stress hits, the pallet gets bit up and the tube disappears first. That is how the checkout scanner starts beeping before your chart turns. COMEX defines eligible silver as metal that meets specs without a warrant, and registered silver as eligible metal with a warrant issued. Which means you pay first. A huge inventory headline can be real and still untouchable. You cannot spend eligible metal at the retail counter. A warrant is the switch that turns stored metal into deliverable metal. When that switch stays off, premiums punish anyone waiting politely. The receipt prints higher while you stare at the same spot quote. For the 1,000-ounce silver futures, delivery is made with an ACE, and 5 ACEs can be converted into one 5,000-ounce COMEX silver warrant. It looks like you are taking metal, but it is a ledger instrument that points to metal. That structure matters because it keeps the wholesale unit intact. Retail demand wants slices. The system hands out fractions of a warehouse claim. When fear hits, paper claims can shuffle faster than bars can move. Your survival mistake is assuming fast claims equal fast delivery. LBMA published in 2021 that CME describes EFP as switching gold or silver futures positions to and from physical unallocated accounts, quoted as a dollar basis versus futures. The moment the basis jumps, your dealer quote starts acting strange. A desk quietly negotiates off screen, the futures print keeps flowing and you feel nothing. Then the spread on small bars widens, shipping windows stretch, and payment terms tighten overnight. That is the mini scene. Pulled quotes, widened spreads, and a checkout line that moves backward. The screen stayed smooth because the pressure vented somewhere else. CME lists trading in the nearest 5 primary silver contract months as March, May, July, September, and December. In practical terms, physical stress is not random, it clusters around a schedule. Dealers and wholesalers do not wait for your chart signal. They manage inventory around delivery windows. The market can feel normal in quiet months, then snap as a delivery month approaches. If you only watch spot, you are watching the calendar too late. Timing is a weapon, and you are handing it away. On October 10, 2025, Reuters reported COMEX silver inventories at about 526.1 million troy ounces. Near a record 531.9 million reached on October 3. That is where the trap closes. Big vault totals can mask tight availability in the wrong place. A mountain of bars in one hub does not fix a shortage in another hub. If metal needs to move, premiums front-run the move because trucking and financing are not free. The chart sees the move after it happens. Your wallet sees it first. On October 20, 2025, Reuters reported spot silver hit a record $54.47 per troy ounce on the prior Friday and was just below $52 on Monday. It looks like a routine pullback, but it is a stress test for physical sellers. When price whips like that, dealers protect themselves by widening the buy and sell spread. You feel it as a premium that refuses to fall with spot. The risk is not the price level, it is the speed of repricing. Slow charts do not pay fast invoices. That same Reuters report said about 15 million to 20 million troy ounces, or roughly 311 to 467 metric tons, arrived in London over the past week. The mini scene is ugly, bars fly, paperwork piles up, and the retail buyer gets rationed. A wholesale desk will grab a truckload when the basis makes it profitable. Meanwhile, your shop posts an out-of-stock banner and offers a pre-order. The premium rises even as the spot line on your phone looks calm. You are not buying silver, you are buying your place in the queue. Reuters also cited a source saying at least 1,000 tons of silver went into London vaults from the United States and China. In human terms, that is emergency plumbing, not normal commerce. Metal only makes those trips when the price gap is wide enough to pay for chaos. By the time you hear about the flow, the easy metal is already spoken for. The premium is the scar left by that scramble. Do not confuse movement with abundance. Reuters said London vaults held 24,581 tons of allocated and unallocated silver as of end September, valued around $36.5 billion. Which means you pay first. Large vault numbers do not promise free inventory. People will tell you that much silver means there is no shortage, and they will sound confident. The mechanism says otherwise because availability depends on ownership and willingness to lend. A vault can be full and still feel empty at the margin. The margin is where small buyers bleed. Metals Focus estimated that 83% of silver held in London vaults had been allocated to exchange-traded funds as of end September. It looks like a giant pool for everyone, but it is mostly reserved seating. When ETFs lock up metal, the remaining float gets thin and jumpy. Thin float means small shocks move premiums fast. This is why the first signal is not the spot chart, it is the ease of getting a firm quote. If you want metal, you must track the float, not the headline. Reuters reported about 697 tons of silver left. COMEX warehouses after stocks hit a record 16,543 tons on October 3, 2025. Watch the tape at the counter. Buybacks get discounted, then delayed, then declined. A warehouse report prints a number, but logistics decide whether that number is usable. When withdrawals accelerate, sellers get nervous and stop offering tight deals. That nervousness becomes a premium because nobody wants to sell what might be hard to replace. Shortage starts as hesitation, not as zero inventory. Reuters also reported Shanghai Futures Exchange warehouse inventories fell 249 tons in a week to 920 tons, the lowest since May and the largest weekly outflow in 11 years. Here is the translation. Regional drains can happen fast while global charts look orderly. When Asia tightens, London tightens, and the United States gets pulled into the tug. That chain reaction is not visible in a simple spot line. It shows up as longer lead times and harsher terms on small products. The first warning is friction, not price. The United States Mint states authorized purchasers are charged the LBMA silver price plus a $3.05 per coin premium for American Eagle silver bullion. That is where the trap closes. Even the official pipeline bakes in a fixed add-on before retail markup. When acquisition costs rise or blanks get scarce, that premium structure becomes a floor, not a suggestion. Retail premiums sit on top of that floor, and they do not wait for spot confirmation. You do not get to negotiate with a machine. You either adapt or you pay. The United States Mint also lists a minimum ordering requirement of 25,000 ounces for American Eagle silver bullion. It looks like a public product, but distribution is a wholesale club with a massive buy-in. When supply stress hits, that club goes into allocation and the smallest buyers get last call. Your local dealer is downstream of that minimum, so the dealer price moves first. This is why watching spot is like watching the weather from yesterday. You need the supply gates, not the sky. CME published in May 2013 that the 1,000-ounce silver futures contract carried a minimum initial margin of 2,475. Now picture the mini scene. A small margin check opens bid paper exposure and the paper crowd surges in. The futures market can absorb that surge in seconds, but mints and refineries cannot. So spot can lag while your physical quote tightens because the bottleneck is fabrication and distribution. The harsh lesson is simple: leverage prints fast, metal ships slow, and premiums announce the difference. You already know the punchline. The chart is polite, the counter is cruel. When the pipe tightens, the first signal is not a candle. It is friction. It is the moment a quote gets slower, smaller, and meaner. That is the moment you either move like an adult or you donate money to someone faster than you. On December 17, 2025, spot silver hit a record high of $66.87 per ounce. In practical terms, the public price discovery arrived after months of private stress. By the time the headline says record, the physical market has already rehearsed the shortage with longer lead times and harsher terms. The chart finally catches up, then it starts pretending it led the story. It did not lead anything. It just printed the aftermath. On October 3, 2025, COMEX silver stocks hit a record 16,543 tons, listed as 531.9 million troy ounces. That is where the trap closes. A record pile can coexist with a real scramble, because not all stock is for sale and not all stock is in the right place. When the wrong bars sit still, premiums become a punishment for anyone waiting for confirmation. You pay for motion, not for volume. Some people will tell you premiums are just greed. They will say the dealer is exploiting you, end of story. Here is what they always skip. Dealers do not set the wholesale plumbing, and they do not control replacement risk. When the refill is uncertain, nobody sells tight. You can hate that and still lose to it. Anger is not a strategy, but it can be fuel if you aim it at the right lever. On October 10, 2025, spot silver traded around $50.10 after hitting a record $51.22 the day before, while COMEX futures were around $48.10. It looks like one market, but it is two markets arguing about location and immediacy. A wide gap means metal wants to move, and moving metal costs money and time. So the premium is the early tax. The chart is the late receipt. That same October 10, 2025 report described London lease rates a little over 11%. The mini scene is simple. Borrowing costs spike, wholesalers get jumpy, and your dealer stops honoring yesterday's quote. A shop that used to answer in seconds starts answering in minutes. Buyback spreads widen even when spot is flat. You can feel stress in the way a human voice hesitates before naming a price. That hesitation is your real indicator. If you want survival, stop treating this like a quiz where the chart gives you permission. Track the things that scream before spot does. Whether quotes stay firm, whether sizes stay available, whether the spread stays tight, whether shipping stays normal. When the market is healthy, it feels effortless. When it turns, everything becomes sticky. Stickiness is the warning. Price is the headline. On October 20, 2025, an independent trader estimated around 15 million to 20 million troy ounces arrived in London over the prior week. In human terms, that is a fire brigade, not a grocery run. When metal gets rushed into a hub, someone is paying up to stop the bleeding. Retail never sees that rush directly. Retail sees the echo: product limits, delayed deliveries, and premiums that refuse to come down when spot dips. As of end September 2025, London vaults held 24,581 tons of allocated and unallocated silver, valued around $36.5 billion. Which means you pay first. The vault number is not your inventory, it is the network's inventory. That metal can be owned, pledged, or reserved long before you click buy. So a vault can look full while the marginal ounce is scarce. The marginal ounce is what sets your premium. Metals Focus estimated that 83% of the silver held in London vaults had been allocated to exchange traded funds as of end September 2025. It looks like a massive pool, but it is mostly reserve seating. When most inventory is spoken for, the remaining float becomes thin and jumpy. Thin float is why premiums react before spot. The market is not lying to you. You are just watching the wrong screen. Another source familiar with the flows said at least 1,000 tons of silver went into London vaults from the United States and China. The mini scene is brutal. Trucks and paperwork move faster than fabrication, and small products become the last priority. While big bars migrate, small bars vanish. Dealers stop promising dates and start offering estimates. Estimates turn into backorders. Backorders turn into higher premiums. That is the sequence. About 697 tons of silver left COMEX warehouses after that October 3, 2025 record stock level. Here is the translation. The pile can shrink quickly once the incentive flips. When outflows begin, nobody wants to be the seller who cannot restock. That fear changes behavior before it changes spot. The counter starts charging for replacement risk immediately. The chart waits until enough people have already paid. Now the part you do not want to hear. If you wait for spot to look safe, you will keep buying late. Build rules that care about friction, not just price. When premiums widen, treat it like smoke. When lead times extend, treat it like heat. When dealers change terms, treat it like a siren. A premium is not an annoyance. It is the market telling you your timing is bad. The U.S. Mint states authorized purchasers are charged the LBMA silver price plus a $3.05 per coin premium for American Eagle silver bullion. That is where the trap closes. There is a built-in add-on before retail even begins. When stress hits, that add-on becomes a floor under your costs. So you can watch spot fall and still not see your checkout price fall with it. The machine does not care about your feelings. The same U.S. Mint page lists a minimum ordering requirement of 25,000 ounces for American Eagle silver bullion. It looks like a public product, but it is distributed through a wholesale gate with a huge entry fee. That gate decides who gets supply first when things tighten. Retail is downstream, and downstream always feels scarcity first. So stop begging the chart for truth. The truth shows up as friction, then as premium, and only then as spot.